Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG. Thought we would come to you today with a brief market update, kind of let you know what's going on out there. S&P 500 right at 4870 right now, which is an all-time high. The rally that we had seen start back in October has really just continued into January. So the S&P 500 up about 2.5% year to date for 2024, and up about 19% since the end of October. So clearly a very, very large market rally. Largely driven by interest rate and economic picture, all of which we are going to get to towards the end of the update. Would just note, as a little bit of an aside, it is earnings season. And so far, we've had about 100 companies in the S&P 500 report. Net income, actually, earnings for those companies is down about 3% year over year. That's versus about a 2% overall EPS growth expectation for the S&P 500. So earnings coming in a little bit lighter than where we'd expect. Revenue is actually coming in at plus 3% year over year, right in line. I would just note that we've only seen about 20% of the S&P 500 report. We've still got the bulk of the earnings season to go. And the fact that the S&P 500 hasn't reacted materially negatively to that shortfall in earnings, it's a more of a mix issue in terms of some companies reporting at the front end versus companies reporting at the back end. So hopefully we will see that kind of level out throughout the course of earnings season. Big news out today on the economy. GDP grew at 3.3% for the fourth quarter. That is a big beat. Consumers out there spending and buying for Christmas and doing all of those types of holiday shopping events. Much better than expected. Wall Street was looking for more like a 2% growth number. And I would just point out that highlights, what we've talked about previously in terms of market updates, which is this market rally, the fact that interest rates on the 10-year Treasury have come down from 5% to 4%, the overall economic strength that is out there, may create a little bit of pushback on this whole notion that the Fed is going to be inclined to lower rates anytime soon. The economy is still rocking along, at a very strong clip. That's not a bad thing, but it may give the Fed a little bit more air cover to start talking about, to push back on the notion that they need to start lowering rates in the early part of this year. And indeed, we will see the Fed come out and give commentary here at the end of the month. And I would expect them to push back on the notion that there are rate cuts imminent, largely because of the positive economic data that we've seen and the fact that inflation still isn't down near that 2% target. I think it's widely expected and commented that last 1% of inflation, so getting inflation from 3 to 2, may be a little bit harder than it was to get inflation from 6 to 3. So with that, as always, if you have any questions, please reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you soon.